Welcome. In this video, can Xcn coin rise 22x and make a new high? We will analyze this. Don't forget to subscribe and like, and please watch to the end to understand.
First of all, it is necessary to talk about the existence of such a downtrend, because in technical analysis, downtrend structures always play a critical role in understanding the direction of the market and gaining clues about how the price may move in the future. A downtrend occurs when the price consistently makes lower highs and lower lows over a certain period of time. In other words, every new attempt to rise stays below the previous high, and every new drop falls below the previous low. This shows us that sellers dominate the market. Even though buyers try to push the price up, selling pressure prevails each time and drags the market down again. Therefore, while the existence of a downtrend may seem to paint a negative picture, in reality it creates a huge opportunity for investors to understand when this trend will break. Because once a downtrend is broken, market psychology shifts instantly. Sellers' dominance ends and buyers step back in. At that exact point, when the price breaks the downtrend, it forms a strong signal for an upward movement. When a downtrend breakout occurs, it's almost like a revolution in market dynamics. Investors realize that the long-lasting decline has come to an end, and this awareness brings with it a great sense of confidence. Buyers who had been waiting on the sidelines out of fear that the trend would continue finally step in. They know that the downtrend line acts like an invisible wall, constantly pressing the price down, and once this wall is broken, the pressure disappears. In investor psychology, this is perceived as a price movement breaking free of its chains. That is why a downtrend breakout is not only a technical event, but also a psychological turning point. What matters here is that the breakout is real and strong. If the price moves slightly above the trend line and then falls back below, it can mislead investors. However, a breakout supported by strong volume confirms that the trend has ended and signals the beginning of a new bullish wave. After a downtrend breakout, the price usually begins forming a new uptrend. At this stage, other tools of technical analysis also come into play. Fibonacci levels, moving averages, oscillators, or chart patterns supporting the downtrend breakout make the probability of a bullish move much stronger. The most critical point for investors is that after the breakout, new lows and highs start forming at higher levels. In other words, if the price begins making higher lows, it becomes clear that the downtrend has ended. In this case, confidence in the market rises, and the number of participants joining the uptrend quickly grows. Especially after the breakout of a long-lasting downtrend, the pent-up buying pressure comes into play and can push the price up very quickly. Another important point to remember is that a downtrend breakout is not just a technical signal, but also closely tied to fundamental investor psychology. When the market is constantly falling, investors lose hope, sell their assets, or avoid new entries. But when the downtrend breaks, this pessimism is replaced with optimism. Investors who previously stayed away out of fear rush back in so they don't miss the bullish train. This accelerates the price rally and creates a chain reaction following the breakout. From a technical perspective, a downtrend breakout is not always considered a full reversal signal. Sometimes it may only be a short-term recovery. However, when a strong, long-lasting downtrend is broken, it often marks the beginning of a larger-scale uptrend. That's because sellers who had been suppressing the price for a long time lose their strength and buyers take control of the market. As a result, after a breakout, a new uptrend forms and the price begins to accelerate upward. Especially when the price returns to retest the trend line as support after the breakout, it becomes a reliable confirmation signal for investors. From that point on, the rally is expected to continue in a much healthier and more stable way. The most important thing investors should pay attention to when a downtrend breaks is how strong the breakout is. If the breakout happens with low volume, weak momentum, and lasts only briefly, it may turn out to be a fakeout. But when it happens with high volume, strong candles, and decisiveness, investor confidence grows. In such a scenario, the price accelerates its upward movement even further. That's why a downtrend breakout should be seen as the sign of a new era in the market. Looking at it from another angle, a downtrend breakout actually signals a change in the overall market direction. It's like a ship that had been drifting in stormy seas finally spotting the harbor. For investors, the breakout of a downtrend is like seeing the light at the end of a dark tunnel. This psychological shift spreads through the market like ripples and further strengthens the upward movement. In addition, a downtrend breakout can also serve as the starting signal for many different chart patterns in technical analysis. For example, double bottoms, inverse head and shoulders, or flag and pennant patterns often are triggered along with the breakout. The formation of these patterns increases the bullish potential even further. Thus, a downtrend breakout is not just a standalone signal, but the starting point of a much larger bullish story. But we can't make decisions based solely on trends. So let's also take a look at other metrics. Stay tuned.
The narrowing of the Bollinger Band is one of the most striking signals in technical analysis, and the potential impact this signal carries on the markets is quite significant for investors. The Bollinger Band, developed by John Bollinger, is an indicator that expands and contracts according to price volatility. The logic behind the bands is actually simple, but when interpreted correctly, it can provide major forward-looking insights. Under normal conditions, price movements fluctuate within the bands according to a certain level of volatility. However, during periods when price fluctuations gradually decrease, meaning volatility drops, the upper and lower bands move closer together, creating a visible narrowing on the chart. This narrowing signals that the market is temporarily consolidating and that a strong price move is likely to happen soon. Because a consolidation cannot last forever in markets, the price will eventually break in one direction, releasing built-up energy. For this reason, Bollinger Band narrowings are considered one of the most critical moments for investors to develop strategies for the future. When the Bollinger Band narrows, the market is dominated by a kind of silence. This silence is like the calm before the storm. Buyers and sellers seem to have reached a balance. The price moves within a certain range, volume is relatively low, and investors are in waiting mode. However, this waiting cannot last long because, by market psychology, one side will eventually prevail. When that happens, the price makes a sudden move outside the bands, often marking the beginning of a strong trend. In other words, the narrowing of the Bollinger Band signals that the energy accumulated in the market is about to be released. Just like a compressed spring quickly expanding when let go, the price makes an explosive move after the squeeze. This move can be upward or downward, but the only certainty is that volatility increases after the narrowing. That is why investors must be particularly cautious during this period, as opportunities grow along with risks. During the narrowing phase, the price often hovers around the middle band. The middle band is the 20-period simple moving average and represents the short-term balance of the price. If, during the narrowing, the price manages to hold above the middle band, it strengthens the likelihood of an upward breakout. Conversely, if the price remains below the middle band, the probability of a downward breakout is higher. However, it is difficult to make a definitive prediction, which is why investors should look for additional confirmation signals. When the Bollinger Band narrows, investor psychology also becomes quite tense. Everyone knows a breakout is coming, but uncertainty dominates regarding its direction. This uncertainty pushes investors either to stay cautious or to take aggressive positions. Some investors avoid trading during this time, waiting only for the breakout. Others try to anticipate the breakout direction and open positions in advance. But the risk lies in the possibility of the breakout occurring in the opposite direction. For this reason, professional investors usually avoid entering a trade before seeing a confirmed breakout, because while the narrowing of the Bollinger Band certainly signals an upcoming move, it does not guarantee its direction. At this point, let's break down the scenarios that may unfold after a narrowing. If the price strongly breaks above the upper band, it shows that buyers have taken control of the market. Volume usually increases at the same time, and the price begins an upward trend. Especially after a long period of narrowing, an upward breakout can signal the start of strong and lasting rallies, as the long-suppressed price energy is released upward. Similarly, if the lower band is broken, selling pressure dominates. This indicates that the price may make a sharp downward move. Thus, the breakout that follows the narrowing becomes the critical moment that determines the direction. Narrowings are often associated with important news flows or market expectations. For example, in the crypto market, before a major update, regulatory announcement, or macroeconomic development, the price may consolidate. This happens because investors avoid making big moves in times of uncertainty and prefer the wait. However, once the news is released, the price suddenly makes a sharp move and the narrowing ends. This is why Bollinger Band narrowings are closely tied to not only technical factors, but also to fundamental ones. Professional investors therefore try to combine both technical and fundamental analysis to make more accurate predictions about the move following a narrowing. The duration of the narrowing also matters. Short-term narrowings may signal smaller moves, while long-term narrowings can lead to much larger breakouts. In other words, when the bands stay close to each other for an extended period, it means the price energy is continuing to build up, and eventually a very strong move is coming. In this sense, the size and duration of the narrowing provide clues about the potential magnitude of the future move. For investors, the most critical issue is turning these narrowings into opportunities. This is because the biggest profits in the market are often made at the beginning of strong trends. Bollinger Band narrowings signal these very starting points, making them strategically valuable. An investor who enters at the right time can profit from a large part of the trend. Therefore, Bollinger Band narrowings create a window of opportunity for patient investors. However, impatient ones may enter trades at the wrong time and suffer losses. Here, patience, discipline, and proper analysis are crucial.
The price first rising strongly, then moving sideways for a period, followed by another upward move, and currently being in another sideways consolidation phase, can actually be considered a pattern frequently observed in technical analysis. These types of price movements generally reflect market dynamics, investor psychology, and the balance between buyers and sellers. A price never rises or falls in a straight line. Instead, price movements develop in waves. During uptrends, the price moves rapidly upward, after which investors begin to take profits, causing the price to move sideways within a certain range. Later, with new buyers entering the market, another strong increase can occur. The current structure reflects a similar situation. In other words, after completing its first major rise, the price moving sideways for a period, then rising again strongly, and now leveling off, could indicate a new upward movement. Sideways periods are generally considered times of uncertainty in the market. During these periods, a balance forms between buyers and sellers, and the price moves within a narrow range. However, considering past examples, the upward movement following the sideways period has been very strong, increasing the price 22 times. This suggests that if a similar structure occurs again, the price could potentially gain significant upward momentum. While it is impossible to know for certain if past behavior will repeat exactly, such similarities provide encouraging signals for investors. In technical analysis, there is a principle: specific past price patterns can repeat in the future. Therefore, the current sideways movement could be interpreted as a preparatory phase for a new major breakout. The market's apparent calm during these periods can be deceptive. Even if the price seems stable on the surface, market participants are positioning themselves. Large investors, or whales who shape market depth, gradually accumulate during these sideways periods. This accumulation usually occurs when the price isn't moving much and volumes are relatively low. Small investors may become frustrated with the silence and leave the market, while major players prepare for a significant future rise. Therefore, the current sideways movement could actually be a quiet period, setting the stage for a potential explosive move. The possibility of a 22x rise happening again is an enticing prospect for investors. Such magnitude of gains is rare in financial markets and represents significant profit opportunities. Psychological factors are also very important here. The fact that a 22x increase has occurred once already embeds the possibility into investors' subconscious. Human psychology makes it easy to believe that something that happened once can happen again. This boosts market participants' expectations and helps the price rise more easily. Especially in crypto markets, investor expectations can directly influence price movements. In other words, the potential for upward movement is reinforced not only technically, but also psychologically. Now that the price has gone sideways again, the situation looks very similar to the previous rise. In the first rise, investors bought enthusiastically, followed by profit-taking, and the price entered a sideways phase. Then, the market gathered strength again and achieved a massive increase. The recurrence of a similar scenario strengthens the idea that history could repeat itself. Of course, nothing is guaranteed, but these repeating patterns are very important for investors, as market psychological cycles often form around recurring structures. If this pattern works again, meaning a strong breakout occurs after the sideways period, the price could potentially achieve another 22x increase. The key point to watch is which direction the price breaks out from this consolidation. If the breakout is upward, a new rally may begin. This would excite investors again, bringing in new buying and creating a self-reinforcing cycle of upward movement. As the rise starts, investors waiting on the sidelines rush to enter the market to avoid missing out, which pushes the price even higher. In such a scenario, the possibility of a 22x move occurring again seems feasible from both a technical and psychological perspective. Technically, the price progressing in a pattern similar to the previous one, combined with investors recalling the past and adjusting expectations accordingly, could support the upward move. There is also a saying in the market: history never repeats exactly, but it often echoes. The price may not rise by the same multiple, but the idea of a strong increase is quite compelling. In conclusion, the current price movement closely resembles the scenario observed in the past. The price first rose strongly, then moved sideways, rose again, and is now leveling off once more. This structure could be the preparatory phase for a new rise. If a breakout similar to the previous one occurs, a significant price increase is possible. Whether a 22X surge happens again is uncertain, but at the very least, the potential for a strong upward move appears high. Therefore, the current calm could signal a major opportunity period for investors.
Yes, friends, I hope you liked the video. If you subscribe to my channel and like the video, more videos will be coming. Be careful in your investments, analyze the risks correctly, and always take strategic steps. I will be with you with different analyses, investment opportunities, and technical information in my videos. I wish you all a lot of profit. See you soon.